Good afternoon and welcome to our virtual class in your subject BAMN 6004, and that is personal finance. Our discussion today is about basic ideas of finance, and that is week 3. And I'm your professor, Susan Maminta from Alma East Rizal branch. In our discussion today, the learning outcomes are to identify and compare the sources and uses of income, identify the purposes and uses of assets, define equity and debt, and to describe how sources of income may be diversified. So what is income? Income, that is the question of where does income come from? So in Tagalog, income is yung ating pinagkakakitaan. No? So where does income come from? Can be from employment, if you are employed, of course, or it can be from this self-employed. That means you have your own business. And also, if you have the big amounts of money in the bank and this earn interest, then it's considered the income or the interest income is considered as your income or the sources of your income. Same thing with other earned interest if you have investment. And dividend. What is dividend? Dividend, if you have the shares of your stocks, then you are entitled for dividend. And that is the term for the income of shareholder or stockholders from corporation. There are two fundamental ways of earning income. One is selling labor and the other one is selling capital. For selling labor, as I have said a while ago, if you are employed, then you are selling your skill to the company, and for that you are entitled for salary. Another one, if you have this business and this is you are self-employed, of course you are selling your skill in your own business. And the next, this selling capital, that is about investing. For example, you bought shares of stocks, and then your shares of stocks is entitled for regular dividend. Then that regular dividend payment to you is considered as your income. After knowing on where does the income come from, then also a question on where does income go? Of course, the answer is expenses. We use our income for our expenses. So what are our expenses? We have these essential expenses like utilities, Miracle, water bill, our internet connection, food, grocery items, and even rental fees are considered as essential. And what about expenses for travel, expenses for our health, expenses for our vitamins, and expenses for our education, for personal growth. So when income is less than the expenses, you will have a budget deficit. And when income is greater than your expenses, that is a budget surplus. And this is what we want. I have here a simple illustration of a budget deficit. A budget deficit that when your income is less than your expenses, and knowing that you are deficit, what will you do? One is to reduce expenses. Okay, and another one, increase income. But if you are not successful under these two options, you may resort to borrowing. In reducing expenses, that means you consume less. Like what? Instead of using your aircon for a whole day, then you better to use that for 4 hours in a day. And for that, your deficit will be reduced. Instead of having snacks 3 times a day, why not have that once a day? Increase income, that means you are going to sell more of your labor, or you can have an investment that can earn interest or income. Like what? If you want, you can have your tutorial after office hours, or you can maintain books of accounts. And for that, there is an increased income, and that will reduce your deficit. In borrowing, as you may resort in this option, if you have this budget deficit, this option is not good in managing our own personal finances, because in borrowing, you will only incur additional expenses that is in the form of payment of interest charges. And this will also increase your budget deficit, not on the current period, but on the next period. So, as I have said, to eliminate deficits, these are the options, but we are not endorsing this one, as this will only result to more expenses to you. So if we have savings, and this savings, that means we have budget surplus. That means our income is greater than expenses, then you have budget surplus, so easy for you to have your savings. So what are the different savings that you can use? If you have this surplus, you can keep your savings in the bank by having a savings account. Or if you want, you can contribute to your retirement account, or purchase a certificate of deposits, or even buying a government savings bond. Or if you want, you can have this money market. You can place your money or portion of your savings in this money market account. So when you have this budget surplus, that means there is an increase in expenses and you consume more, then what will happen to you? Your budget surplus will be reduced. So you should not be complacent when you achieve this one, budget surplus, as this may result to decreasing or reduce if you still maintain this increasing expenses because you consume more, or you reduce your income, the sources of income, you stop your tutorial. And for that, that is also a reason for reducing your budget surplus. Instead, we recommend that you save and invest more, or save more and invest more if you have already attained this budget surplus in your financial. And with that, increasing more income, and that means an increasing budget surplus. In handling our finances and in the expenses that we have in our day-to-day life, we have this opportunity cost and sunk cost. When we say opportunity cost, this is the return of a foregone option that means less than the return of your chosen option. For example, class, you have these two options to buy for yourself, and that is buying boots or buying jacket. So if you choose to buy jacket and the foregone cost is your boots, because your option, you choose jacket over the boots. So the foregone option of which is the boots, that is your opportunity cost. While a sunk cost are costs that have already been spent. So whatever resources you traded are gone and there's no way to recover them. So assuming that your choice is the jacket and you already paid that, you have already with you your jacket. But after some times, after you bought this jacket, you find out that there's a need for you for a new boots. So that means you have already incurred sunk cost, because the sunk cost here is the cost of the jacket, which is not much more important than the buying your boots. So here, if we know and we have monitored in our disbursement this sunk cost, this will serve as a lesson learned to us that next time we must be careful in choosing the option, the best option that our income will be used. Under this topic, we have also these assets. What is these assets? As an individual, we can have assets and we consider this as our wealth. Assets can be in the form of fixed assets, like what? If we have this furnitures in our house, our appliances, and our house and lot, our jewelries, these are examples of assets that we considered as our wealth. Now, in the assets, in selling this, we can have capital gain or capital loss. Having our assets sell at a price higher than its acquired cost, then we can have a capital gain. Opposite to that is the capital loss. That means you acquired your assets at a higher cost and sell it at a lower cost. Again, when you have assets, you buy that at a lower cost and able to sell that at a higher cost, then you have a capital gain. But buy that asset at a higher price and sell that at a lower price, then it is a capital loss. Our assets can create income. In what way? So if you use your assets that is in the form of investment, like what? Like having an apartment, okay, the rental fees that you collected, then that is the income. Or if you have these machineries and offer for rent, then that rental income from machineries are your income. Another one, or a good example of this creating our assets into income is by sharing, by buying share of stocks. If you have these shares of stocks, that are in the financial platform, you can sell that in that same platform. So selling that stocks at a higher price, then you have income. Or your investment in shares of the stocks earns dividend. So if you have this regular dividends from the company or from the corporation of these shares of the stocks that you bought, then you have this regular dividend, and that is your income. Assets reduce expenses. What do we mean by this? If you have this house and lot, you applied for a mortgage for this house and lot, and therefore you are now free from paying rental because you have already your own house and lot. And that way you have reduced your expenses. And what about another one? If you are only having a car for rent, and that instead of having that car for rent, why not get your own car? And in that way, you are reducing your expense. Or another one, if you have that car, then you are now free from paying taxi fare. So assets have different roles in our life. As we have here, the car, as an example, car as an asset can reduce your expense, like your fare or taxi fare. It increases income? No, if you are not going to have this for rent. But if you want, you can have this for rent every weekend. So that is also another income to you. It is store well? No. Why? Because the car has no appreciating value. Instead, it has depreciating value. And what about a home? So if you have home, of course, you have this mortgage to pag-ibig because of this house and that. Then you have now your home. That means you are now free from the expense of rental fee, and but on the other hand, it decrease your income because you have to pay your monthly mortgage. But it's yes for storing wealth because lack appreciates value. And having said that, that means you are storing your wealth. In our discussion today, as we have discussed about this savings and surplus and deficit, then we have this debt and equity. Debt and equity means when you have buying capital, that means you are using people's money to finance your investment. And that investment is a capital. That means it gives you equity. On the other hand, if you have this borrowing capital, it gives you debt. Then, what will you do? If you have this borrowing capital, you can have this borrowing capital as long as you increase your income and decrease your expenses. Like, if you want your car, okay, you have debt on this car because you borrow capital in that, in financing your car, okay, you can increase your income in that car, right? They have this available for rental every weekend since you don't have work at every weekend, so you can have that as additional income to you. And at the same time, it decreases expenses because you are not going to travel anywhere. Instead, you are there for your rental business for your car. So the cost of debt and equity, that means it is equity when you trade, and that is by capital. But when it is borrowed capital in the trade, then that is debt. And as to cost and expenses under equity, you have profits and gain, while in debt you pay interest. In the market, as if for equity, you are dealing in the capital market, and when it is debt, you are dealing in a credit market. If you have debt, and like for example, you have debt in credit cards, you use the debt in your living expenses if it is a credit card. And the value you achieve is the convenience. The convenience of keeping your money, okay, and it is safe. And it can be paid through your income, your credit card expenses of purchases made through credit card. An auto loan that is also a debt, and the value is that it reduces your expenses. As I have said, instead of paying taxi, you will be free from that. And it will be paid, of course, from your income. A mortgage like home, it's reduced expenses, of course, and it can also be paid from your income. A college loan, like an example here, for what reason? That is for education, and the value, it can increase income in the future, and it can also be paid through income in the future. So if you have this analysis of your debt, knowing the reason on why you have debt or why you acquire debt, and you know the value, then it's okay also that you know on where to find the payments of this debt. As long as you know that there will be sources of payments of this debt, then it's okay. As we are discussing about this asset and risk is involved. Here in managing our finances, it is a must that we know how to protect our income. And protecting our income, there are risks. And to avoid this risk, we have to diversify our investment, and in that way, we are spreading the risk. What do I mean with this class? If you have that money, protecting your money, make sure that it is free from risk. Instead of having that in your house, place that in a bottle jar or in a plastic jar. There is a risk of losing that money. Okay? And why not have that deposited in the bank and you have this interest? Then knowing that the banks only guarantee you for 500,000 return of your deposits. That means if you have 1 million in that bank and that bank okay, was closed due to bankruptcy, then you are only insured for 500,000. That means the bank will only pay you for 500,000 because that is their PBIC insurance. You are only protected up to 500,000. So what will you do if you have so much money? Don't just invest your money in one bank, in a single bank. You can spread or have several bank accounts and then have this be deposited from these different banks. So in that way, you are spreading the risk. And that is the last topic in our discussion today. And again, thank you for listening. Bye.